Hello, everybody. So, today we're going to be talking about market structure. It is very important that you understand market structure because each and every trade that you are going to take, it will be depending upon the market structure. The market structure is your map in Forex trading. It tells you what to do, when to do, and where to do it from. Okay. So we have two ways in which the market behaves in the market. So the first one is when the market is in trending. And when the market is trending, what do we have? We have two things that the market is going to be doing. It is either going to be giving us an uptrend or it's going to be giving us a downtrend. Okay. Downtrend. So these are the types of trends that you find under trending. And the other part which you are going to find when we are talking about the market is you always find the market. At times you find the market in consolidation. Okay, so each and every time you open your charts, you either find your market trending, which can be in an uptrend or downtrend, or you are going to find the market in consolidation. Okay, so we are first of all going to talk about the trending market, then we are going to talk about the consolidation market. So when the market is trending, it means that the market when the market is trending, it means that the market is breaking highs or lows. Okay, so when the market is trending, it's breaking highs or it's breaking the lows. So when the market is in an uptrend, it means that the market is breaking the higher highs. Okay, so we have said that when the market is in an uptrend, when the market is in an uptrend, the market is breaking higher highs. Okay, so when the market is in an uptrend, it is breaking higher highs. And when the market is in the downtrend, it is doing the opposite. So when the market is in the downtrend, the market when it's in the downtrend, okay, it is breaking the lower lows. Okay, it is breaking the lower lows. So let me just give you um, a line structure of the market when it is in an uptrend. So we say that when the market is in an uptrend, it is breaking the higher highs. Okay, it is breaking the higher highs. So what you are seeing right now, this is just a rough view of how the market is moving when it is in an uptrend. Okay, so when you look at the market right now, what are you seeing here? What you are seeing here, this point where the market has created a higher high. After creating a higher high, what did the market do? It gave us a pullback to this point. After giving us a pullback, the market continued moving upward. When it when it went upward, what did the market do? It gave us a break of the market structure again, breaking this higher high. The market gave us another pullback. What are we expecting? We are expecting the market to give us a break of this higher high. So this is what the market does when it is in an uptrend. This is what the market does. Okay, this is what the market does when it is in an uptrend. Okay, so these are your higher highs which the market is breaking. So if the market has a higher high, which means it is supposed to give us a higher low. And this is the higher low which we have here. So every time the market gives us a breakout, when it breaks our higher high, the market creates a higher low. Every time the market gives us the break of the higher high, the market creates a higher low. Whenever the market gives us a break of the higher high, the market creates a higher low. When the market gives us a breakout of this higher high, we have a higher low. Okay, so you cannot have this higher low if the market has not broken this higher high. Right, so let's go to the next part where we are going to be talking about the downtrend. So when the market is in the downtrend, what does the market do? The market is breaking the lower low. Okay, it is breaking the lower low. This is what the market is doing. It is breaking the lower low. Okay, so we say that when the market is in an uptrend, it is there breaking the higher high. So when it is in a downtrend, it is actually doing the opposite of what it was doing when we had an uptrend. So this time around, the market is having to break the lower lows. Okay, it has to break the lower lows. So these are the points that the market is supposed to break. So when the market gives us a breakout of this lower low, we are expecting the market to leave a lower high. So when we have this lower high is only going to come when the market gives us a breakout of this lower low. After this break of this lower low, we are expecting the market to give us another lower low. After that, when the market gives us the break of this lower low, when this lower low is broken, the moment it is broken, we now have the lower high. Once the market gives us a pullback, we are now also going to have another lower low. And for us to have the lower high, we have to wait for the market to give us a break of structure here. Once the market gives us a break of structure, we are now going to have ourselves a lower high. So this is how the market moves. When the market is moving in an uptrend, we are expecting the higher low to be strong and the higher high to be weak. Okay, so let me say this again. Let me say this again. So when you look at the market where it is right now, okay, when the market is in an uptrend, we are expecting the higher low to be strong. Okay, and we are expecting the higher high to be weak. Okay, so why are the higher highs being broken? They are being broken because they are weak. Why are the higher low being able to break the higher high? It's because they are weak. Okay, so each time we see a breakout, it confirms that this higher low is weak. So the market is going to keep on pushing upward up until the market finds a strong higher high and the higher low becomes weak that it cannot hold the price and the price gives you a breakout. So for as long as we are having the strong higher low, we are expecting the market to keep on pushing upwards. So this higher high is weak, this higher low is strong. So as I had said, when the market is in an uptrend, the only time that you are going to have a higher low is the time when the market gives you a breakout. So when you have this higher high and this higher low is only going to appear when there is a breakout here. So every time we have a breakout here, the higher low has to appear. Every time we have a break of a higher high, the higher low has to appear. This is the same formation that you are going to be finding in the market. It also goes when the market is in a downtrend. This lower high is only going to appear when the market gives us a breakout here. Okay, this lower high is only going to appear when the market gives us when the market gives us a break of structure here, when it gives us a break of lower low. When this price comes here and gives us a breakout here, we are going to have the lower high. Okay, so you can never have the higher low or the lower high minus the market giving you the breakout. So this breakout here, this is what we call break of structure. Okay, this is break of structure. Whenever the market gives you a breakout of the lower low or the higher high, which means whenever you see this one, whenever you see this, which means you are having a break of structure every time you see the break of the higher high or the lower low. Okay, so one thing which you have to remember every time when you are in an uptrend, what should be broken is an HH. Okay, a higher high, H, a higher high. When you are in a downtrend, what has to be broken is a lower low. Okay, just remember this: lower low, higher high. Okay, then what is supposed to be strong when you're in an uptrend is the higher low. What is supposed to be strong when you're in a downtrend is the lower high. Okay, so just remember this: in an uptrend, you're expecting this one, which has different letters, to be strong. Okay, which has different letters, to be strong. This one, which has same letters, you're expecting it to be weak. This one, which has same letters, you're expecting it to be weak. This one, which has different letters, you're expecting it to be what? Expecting it to be strong. This is a trick. If you're always finding it so hard to see, okay, which one among these is going to be strong, which one among these is going to be weak, just go with this. Same letters, weak; different letters, strong. Whichever direction that you're going to be moving. If the market is an uptrend, the higher high is definitely going to be weak. The higher low is going to be strong. And when you're in a downtrend, it's the same thing. You find yourself like having the lower low weak and the lower high strong. So this is how the market move in a rough way. So now let us have a presentation on how the market normally moves when because right now this one which we have shown you, this is just a presentation of the way the market moves, but this is not how the market moves. When you open the charts, you find out that the market is moving in a different way. So when the market is moving, it will give you this side, gives you a pullback like this. Okay, after that, it gives you a breakout, gives you a pullback, push, gives you a breakout, push. Okay, so this is how the market moves. Okay, this is how the market moves. When you open the chart, this is what you are going to be seeing. This is what you are going to be seeing. You are not going to be seeing a perfect high. You're not going to be seeing a perfect low. You're going to be seeing something like this. This is something that you're actually going to be seeing. So when you open the market, don't be surprised like, okay, I'm not seeing the higher high the way I was seeing them in the diagram. No, that's not the way the market is. So there is one thing which we say. We say when the market is in an uptrend, we are expecting the higher high to be broken, and we are expecting the higher low to be strong, to remain intact. Okay, so this is what you're seeing now. This is an uptrend. So when you see the market is being like this, there's one thing that you have to understand. This market, the way the structure is, there is an internal structure and the external structure. Okay, so um, if you really want to be able to analyze the market in a proper way and in a way that you don't get confused, you have to always understand which range you are working with. And once you understand the external structure and the internal structure, it's going to be easy for you not to get manipulated. Okay, so look at this. Okay, when you look at this, what are you seeing here? This is your new higher high. Okay, this is your new higher high, and this is this is your new higher low. Okay, so you have a higher high and a higher low. Okay, you have these 2 points that you are seeing. This point here, this point here, this new higher low and the higher high, whatever that is in between, whatever that is inside here, whatever that is inside here, whatever that is inside here, it is going to be considered as internal structure. Okay, it is going to be considered as internal structure. Everything inside here is going to be considered as internal structure. When the market gives us a breakout here, it doesn't mean that we have finally have our final break of structure and we mark this as our higher low. No, the structure which we are supposed to be seeing as our main structure, where we can say that now the market has given us the break of structure, is this external range here. Okay, when the market is giving you these breakouts, it does not mean that the market has shifted the direction and it's going down. What the market is doing at this particular time, the market is just retracing so that it can sweep some liquidity and continue with the correct direction. So this is just a pullback. This is just a pullback. Our real move is when the market has finally swept liquidity and it is now going to our desired direction. So before the market gives you this breakout, you cannot say this is your higher low. So we are talking about the internal structure and the external structure. Whatever that you are seeing from this point to this point, it is considered to be the internal structure of this range. So this range has this as its internal structure. So we are having this whole range here, which we are having right now, this one. This is our range. So this range is the one which we are considering as our external structure. We are considering this as our external structure. Let me explain this. When the market gives you a breakout of this point here, of this point here, if the market gives you a breakout here before it gives you a breakout here, it does not mean that you have changed the character. You have changed the direction. You are now in a downtrend. No, it means that the market has just swept liquidity. We have to wait for the market to give us a breakout at this point for us to know that we can now go to the downside. As the market is moving in this same direction where it is moving, we cannot say that the market will be in a downtrend if it comes and gives us a breakout here. No, the only time that the market has to give us a change of direction is when the market gives us a breakout at this point. Let me show you. If the market comes to this point and gives us a breakout here, gives us a breakout here at this point, it gives us a breakout here. This does not mean that we are now in a downtrend. No, this is this is internal liquidity. The market has just swept the internal liquidity, and the market is going to continue moving in an upward direction. So this does not mean that the market has changed direction. For us to say the market is now in the downtrend, it needs to break out this higher low, this higher low. So there is external structure and internal structure. Don't mix these two. There is external structure, which has the higher high and the higher low, and whatever that is going to be happening in between the higher high and the higher low, everything that is going to be happening inside, it is going to be considered as our internal structure. It's not our external structure. So even when you see the market giving you a breakout like this one, it does not mean that the market has changed direction. No, it just means that the market at that particular time is just going there to give us a sweep of liquidity. So let us check out this same thing when we are in a downtrend. So it's just basically um the same thing even when you are in a downtrend. So you really have to get a full understanding of the market structure, because if you don't have an understanding of the market structure, you are going to find it so hard for you to be able to have good entries, because market structure is very important. It is the king. It is the king. If you are on the wrong side of the market structure, you always find yourself being liquidity. You always find yourself in a position where the market is hitting your stop loss. Why? Because you don't know where you are in the market. So understand this and go through this video more than 3 times or 4 times until you become so comfortable with the market structure. That's when you can move on to things like supply, demand, resistance, and all those. It will become so easy to you. But if you find yourself trying to move in the market without understanding the market structure, you always find yourself in the long side of the trend. Okay, because market structure shows you the direction where you're supposed to go and where you're supposed to take your trades. So as we have said that when you are in a downtrend, it's just the opposite of what happens when you are in an uptrend. So here we said you can only have this lower, you can only have this lower low when the market, we can only have this lower high when the market gives us breakout of this structure. Let us explain this in a little bit more details. When you look at this lower high here and this lower low, it is an external, it is an external range. Okay, it is an external range of this liquid, of this structure which is here, this whole structure. So this whole structure which is inside him, it is considered to be an internal liquidity of lower high one here. Let me mark lower high one and lower low two. This lower high and this lower low is the external range of this internal structure. Okay, so this structure is considered to be the internal structure of this external structure. Okay, so whatever activities that are happening inside here, they are considered to be just the internal structure of this main structure. This is our external range. So even when we are talking about TP, we are going to be targeting this point. Why? Because this is our external range. Okay, so even when the market gives us the breakout of this part here, this part here, we are not going to consider our market as a change of direction. Why? Because this is just liquidity of this main range. This is just liquidity. We are not going to consider this as the change of character or as the change of direction. Okay, for us to say the market has changed direction, we have to make sure that the market gives us a breakout here. It breaks this lower high. That's when we can now start considering for buys. Okay, for as long as the market is within this whole range, we are going to be looking for sales. Okay, we are going to be looking for sales. For as long as the market is inside here, we are going to be looking for sales. Okay, so let me explain this next part here. Let me explain this next part for you so that you have a better understanding of this. We have this part here. Okay, there is this lower high. There is this lower high. We have this lower high, and we have this lower low. Okay, we have this lower low, and this lower high and this lower low, they make up this range, this external range. Okay, so we have this external range, this external range. So whatever that is going to be happening in between this range, anything that is going to be happening here, for as long as it does not break this lower high and this lower low, everything inside here, whatever the market will be doing here, it is going to be considered as internal structure. It will be called internal structure. So all this that the market is doing, giving us a breakout here, this is not the break of structure. This is just the market gives you a sweep of liquidity, taking out some stop loss. Okay, this is not the change of structure. For us to say the market has changed the break of has changed direction, it has broken the structure, the break of structure, we are going to be counting this one here, this lower high. For as long as the market is down here, it is down, we are still looking for sales. Okay, we are still looking for sales. The only time that we are going to start looking for the buys, it's only when the market gives us a break of structure here. For as long as the market remains in this range, we are not looking for any, not even one buy. But you can still take some buys if you're a pro, you understand the whole thing. You can still take some buys here and there. But if you're a beginner, you don't know anything, just wait for the market to give you a clear confirmation so that you can start buying. So this is the way the market is when it is in a downtrend. You're going to be seeing something like this. So for the next thing, we are now going to just take a quick look at consolidation. We're just going to take a quick look at the consolidation. So consolidation, you always find the market in a consolidation when the market is not breaking any high or any low. When the market is just moving like this, this is when the market is in consolidation. So the market is in consolidation when it is not breaking any high or any low. So and the market is like this, which means the market is in consolidation. Why? Because the market is not breaking any high or any low, it's just in between. So this is what you are seeing here. The market came here, it was rejected. The market came here, it was rejected. The market came here, it was rejected. It came here to this point again, it was rejected. It came here, it was rejected. It came here, it was rejected. Came here, it was rejected. It's the same thing. So the market is failing to give you a clear break of structure. It's just doing this. It's just doing this. So it is very important to understand that when the market is doing something like this, which means the market is creating liquidity. Okay, it is creating liquidity right now because there are stop losses here, there are stop losses there. Okay, there's liquidity everywhere in both directions. So the market can sweep liquidity and sweep liquidity to the top and come again and sweep liquidity to the bottom. And after sweeping liquidity at the bottom, then the market continues going up. So this is what happens when the market is in consolidation. It is not breaking any highs or any lows. It is just in between. Okay, so now let us get into the charts so that you get proper understanding of what we've been talking about, so that you have a clear picture on how to read the market. So we're just going to start here. Okay, this is where we're going to start from. Okay, so when you look at this point, okay, let us say this point here, this point is our last higher high. Okay, the market gives us a breakout here. The market gives us a breakout here. The moment the market gives us a breakout here, what are we expecting? We are expecting this point here. Okay, let me also teach you here with something which is very important, which we're talking about how to mark the higher low. When you are marking the higher low, this is your higher high. Let's say this is your higher high. Okay, this is your higher high. This is your higher high. When the market gives you a breakout like this one, you have to get your rectangle to it. You come to this candlestick which has the wick. You come to this candlestick which gave you a breakout. You pull it down to the bottom. Okay. You look for the lowest point inside this rectangle. Okay. Then that is going to be your higher low. Okay, that is going to be your higher low. So we're going to mark this point as our higher low. This point is our higher low. Okay, so we have this point as our higher low, we have this point as our higher high. So the moment the market gave us this breakout here, when it gave us the breakout and gave us this pullback, where is our higher high? This is where our higher high is. This point here. For us to have a higher low, what do we have to do? We have to wait for the market to give us a breakout at this point. That's when we can have a confirmed higher low. This is what I was talking about. You cannot mark this point as your higher low, even if it came so close to this point. Why? You have to wait for the breakout. Look at what happened. Imagine you had marked this point as your higher low and see what the market did. It came back to this point and gave us a breakout. So you always have to wait for the market to give you a breakout here. Then you can consider having yourself a higher low. So The market has given us a breakout of our previous higher low. What are we expecting? We are expecting the market to give us a downward push. We are expecting the market to push to the downside. Why are we expecting the market to push to the downside? Because the market gave us a breakout of our higher low. We are expecting our higher low to be so strong that it cannot be broken. Okay, here. So the market, after giving us this breakout, it gives us a liquidity sweep and gives us this pullback. After giving us the pullback, what did we say? We say the market is going to create a lower low. Okay, this is now our lower low. This is our lower low. We now have a lower low. We now have a lower low. For this lower low, for this lower low, um, for this lower low, after this break of lower low, what are we supposed to do? We are supposed to do the same thing which we did when with marking our higher low. You have to bring your rectangle to at this point, at the lowest point, and bring it to the candlestick which gave you a breakout and pull it upward. Okay, you pull it upward. This point, the highest point here, it is your lower high. It is your lower high. It is your lower high. Okay. So after this breakout, what did we have? We had a pullback. We had a pullback. From this pullback, when we had this pullback, what did we have? We have this point which was marked as our lower low. This point is our lower low. Um, we need to wait for the market to give us a break of structure here by the body for us to be able to confirm that this is our lower high. You see what I was talking about? So if you mark this as your lower high, what would have happened? The market would have taken you out just like that. Okay, so here we now have our lower high. That's our lower high. That's our lower high. What happened now? The market gave us a break of structure here. What do we have? We have a break of structure here. The market has given us a breakout. What are we expecting since the market has given us a breakout? We are expecting the market to continue pushing upward. Okay, so there is something that I would like to say. When the market gave us this breakout, what are we expecting? See, if you look at, have you seen the way this market structure is? When the market gave us this breakout structure, we are expecting the market to give us a pullback to the 50% of this structure. And the market missed. Okay. And the market continued. We are going to continue using the Fibonacci retracement like this up until the market gives us a pullback to the 50%. So what happens is this: if the market does not give you a pullback to the 50%, which means this part here, this one, it becomes liquidity. It becomes liquidity. So even when the market is moving in uptrend, I already know that this is a liquidity. I know that this here, this is liquidity. So the market keeps on moving in an uptrend. Okay, we have a breakout. We have a breakout here, and the market gives us a pullback. Though this one I cannot mark it as our higher low, and this one I cannot mark it as our higher high. Why? Because the market has not yet retraced to our 50% Fibonacci. The moment I have this market retracing to my 50%, retracing to my 50%, that's when I'm now going to mark this point as my higher high. I'll mark this point as my higher high. Why did I mark this point as my higher high, as a valid higher high? Because I've seen that the market has retraced to the 50%. So what is it that is there now? So what I understand right now is very simple. I understand to say the way the market has moved like this, with the way the market has moved like this to this point, whatever that is going to be happening in between this higher high that I have right now, this higher high, and this lower low right here, whatever that is going to be happening in between this, it is going to be considered as internal structure. It is going to be considered as internal structure. Everything that is going to be happening here, it is going to be considered as internal structure up to this point. Up to this point, it's going to be considered as internal structure. Everything inside here is going to be considered as internal structure. So it doesn't mean that you cannot mark these as your structure. It depends with the taste. There are some people who do not use Fibonacci retracement to mark their structure, and there are some people who use Fibonacci retracement to mark their structure. As for me, to mark a high, I need to see two things. One, the market is supposed to give me liquidity sweep, just like the way the market gave me this liquidity sweep here. The market has to give me liquidity sweep, showing me that it has this strong high. After giving me a strong high, I have to make sure that the market gives me a pullback to the 50%. To the 50%. If the market does not give me a pullback to the 50%, I'm not going to mark that point as my strong high or as my high. It goes the same. So this one, if you look at the way it was, it gave us some liquidity sweep here, and it also gave us some breakout here, and finally gave us a breakout at the bottom here, which means this point is a strong high. This one, it showed that it was very weak. It was very weak. So for the market to be able to push and come to all these levels, which means this structure that I had, this structure that I had, it is the internal structure. So whatever that I'm going to be doing inside here, whatever marks that I'm going to be having here, all these marks, I have to put it in my head that we are not in a downtrend, we are in an uptrend. Okay, so all this that is happening is as a result of the market just trying to induce people to think as if we are now in a downtrend. Okay, so what the market does something like this, because if you do not use your Fibonacci and you don't use the strong high principle, the strong low principle for you to know where the true high and the true low, where the true high and the true low is, you always find yourself stuck into such kind of situation. So let me just try to explain this. So you always find yourself, since the market gave us a pullback, okay, if you don't know that this one and this one is your correct higher high and your correct lower low, what is it that is going to happen? You find yourself marking this as your as your as your lower low, and you are marking this as the lower low. Okay, you mark this as your lower low, and the market continues doing this. You mark this again as your lower low, you mark this uh as your lower high. And when the market gives you a breakout like this one, what do you say? Ah, the market has changed direction, we are now in an uptrend. What do? They push the market to the downside again, still taking this liquidity. You see, and after doing that, after taking all this liquidity, for you, you already know that the market is has broken this. We have now confirmed we are going to continue going to the downside. You wait for the market to come to these levels so that you start selling. When this one becomes a trap, the moment you start selling at this point, you are just going to find the market gives you a pullback and breaks this and continues going up. Why? Because this is our true high, this is our true low. Whatever that is happening inside here, this is internal structure. Okay, this is internal structure. It is the internal structure of this structure. Why am I saying this? I'm saying this because the Fibonacci retracement, the market did not give us a pullback to the 50% of the Fib, and the market at this particular point, it did not give us our strong high, which is showing that the market is going to push to the downside. So you always have to be careful with that. So once the market gives us a breakout, we are not going to get into this uh, internal structure. So at the same time, this is what I was also saying. If you don't know if you don't wait for the market to give you a proper break of the higher high for you to give proper proper mark of your higher low, you always find yourself in such kind of situations where you have already marked saying this is a confirmed higher low, and the market comes and gives you a sweep. So the moment the market gives us the breakout here, what are we going to do? We're going to get this. We are going to get a rectangle to mark this point and this point. After marking this point, what we have, we pull it down. Where is our lowest point? This is our lowest point. Okay, so a higher since we have a higher high, what are we going to have after having a higher high? We are going to have a higher low, a higher low, and a higher high on top. Okay, so let's check on what I had said earlier. I said I'll only mark the market when it gives us a certain pattern on top. So what did the market do on top? It gave us the sweep of liquidity. After giving us a sweep of liquidity, it gave us a sweep, a breakout to the downside. After doing that, let us go to the fib. We check how the market had to move from here to there. Let us check what is the Fibonacci telling us. Have you seen? The market gave us a pullback to this level. It gave us the pullback to these levels. Okay, to these levels. What do I now know? The market was able to give us a pullback to these levels. So I now know that this is a valid higher high. Why? Because the market was able to give me a pullback to the 50% of the Fibonacci. If it does not give me the 50%, I know that this higher high is weak and it is not the higher high which we are supposed to be following. So this is our higher low, this is our higher high. Okay, so we continue. Let me just leave this. So we continue with what we said. I said after this, whenever the market gives us a breakout like this one, whenever the market gives us a breakout like this one, what do we have to use? We have to use the rectangle tool. We come at this point, we come here and pull it to the very bottom. Okay, once you pull it like this, what are you going to have? You're going to have yourself a point where you're supposed to have a higher low, and the point where you're supposed to have a the point where you think the point where you are going to mark your higher low. So this is the point where your higher low is supposed to be. So the market keeps on moving. Okay, what do we have? We have this. The market gives us liquidity sweep. Okay, after giving us liquidity sweep, what does the market do? It gives us a breakout here. Let us check on the Fibonacci. Did the market give us a pullback to the 50%? To the 50%? No, it did not give us the pullback to the 50%. So what do we know? Since the market did not give us a pullback to the 50%, we have to wait for the market to give us a clear sweep of liquidity, because if the market does not give us a pullback to this 50% to sweep liquidity, which means the market is supposed to create a liquidity which is going to take out. So the main reason why the market gives us a pullback to the 50% is for the market to be taking out the liquidity. So if the market has created enough liquidity for it to take out, and continue moving upward, you can then mark this point as a varied higher high, as a varied higher high. Why? Because we understand that the main reason to why the market is always giving you pullbacks is for it to be taking out these lows which are here. And once it has enough, it now gives you a push to the upside. Okay, so the other thing which you can be doing is, if the market gives you a push like this one, this point is still valid. Okay, it's still valid. You can still be using it up until the market gives you a pullback to the 50% of this point. You see, here the market gives you a pullback to this point, so you can still be using it. It's a very good tool which you can be using when it comes to the breakout. Every time the market gives you a breakout, you can still be using it as you are even moving to the even in the lower time frame. You can be using the Fibonacci like this, but you really need to be careful, because you have to be able to figure where you are having a good strong high and a strong low. Okay, so we we have a breakout. We have a breakout here. We have a breakout of our higher high. Why? Because the market was able to take out the liquidity and give us this move. So where do we now have our current higher low? Our current higher low is going to be here. It's going to be here. I have explained why we can still put this as our higher low even when the market did not reach our 50%. Why? It's because the market created liquidity which the market had to take out. Yeah, so you just need to have certain principles that you are supposed to follow as a forex trader, so that you don't get entangled into certain things whereby you find yourself entering trades even when you are actually not supposed to enter trades. So all these things that you are seeing, if you open the lower time frame structure, you find out that you have varied trades. So this does not mean that since we are just having this market structure, we cannot find trade in the lower time frame. No, if you look at this, we are on the H2, so which means in H1, in M30, they are valid trades right here. So the market continues to move. Okay, what does the market do? It gives us a pullback. Let us check if this pullback comes to the 50%. No, it does not hit our 50%. So there is a possibility of this low being liquidity. It does not mean that it is liquidity, but it means there is a possibility of it being liquidity. So what have we seen? The same thing which I was just explaining. Look at what happened here. The market had to come and this, took out this. Why? It's because this market did not, this pullback did not come back to the 50%. If it does not come back to the 50%, which means the market the market is inducing people to keep on buying, so that once it gives us a pullback, this place can be taken down. So we understand that this is now liquidity. So even if we mark it as our higher low, at the back of our heads, we should know that this is liquidity. The market is likely to come to this point. So what the market does is this. We say this point and this point, they did not come give us a retracement to the 50%. But why is it that the market did not give us a pullback to this level so that it can take liquidity? I said, look at this. The market here was generating liquidity and it took some of the liquidity here before it gave us this push the upside. So there was no reason for the market to give us a pullback to these levels so that it can take liquidity. Why? Because it already took liquidity before it gave us a push to the upside. Okay. So we have another setup here. We have another setup here. We have now seen the market has given us a pullback to the 50% here. What do we now know? What we know now is that this is a safe higher. This is a safe higher high. Why? Because it has everything that we need. But at the same time, this one becomes liquidity as well. Why does it become liquidity? It is because we already know that there is liquidity at the bottom here. We already know that the market still has to come here. So there's still probability for the market to take out this higher low. Not because it is not strong or what, but because there is a 50% retracement that the market is supposed to give us. Okay, so this is what we are now seeing after this push. After this push, what are we seeing now? The market gives us a push here, but the market is not giving us a pullback to the 50%. And what are we seeing that is happening now? When the market finally gave us a pullback to the 50% here, the market had given us some liquidity here, gave us some liquidity here, okay, in consolidation, making some liquidity here, giving us liquidity here, and inducing some people to be buying here. After that, what does the market do? What does the market do? Inducing people to do what? To keep on buying here, saying that this is a breakout. We are having a break of a higher high, and some would even mark this point as the point of interest where they want to buy here. But still, the market just had to give us a pullback to these areas. Even when it reached these areas, you can see at least the market gave you a rejection here. Why didn't this part hold the market? Why wasn't this part as the point of your uh, as the point of the higher low? Why? It's because the market did not give us a pullback to the 50%. If it gave us the pullback to the 50%, we were expecting the market to hold. So as I said the market at this particular point, what we have liquidity here, which we believe and know that the market is going to come for it and sweep this liquidity. So after this breakout, what do we have? We now have this. The market has given us a breakout here. So what are we expecting now? We are expecting this to be our higher low, which should be strong, and we are expecting this to be our higher high, which should be strong. Okay, this one we are still marking it as liquidity. Okay, so what happens now? The market gives us a breakout here. Okay, so what are we now going to have after the market gives us a breakout here? The market gives us a breakout here, a breakout here. We are now going to have this point as our lower low, and we are going to have this point as our higher high. Okay, remember I'm analyzing this structure on H2. which means if you are in M30, you are in M1, you can still catch these trades. You can still catch these trades. You can still catch these trades. So it doesn't mean that you cannot do that. Right now, I'm just trying to show you how you are supposed to be thinking when you are in a trade, or how you are supposed to be thinking when you are analyzing the market. So the market gives us a pullback like this one. Once we have this breakout, so we are now going to have our lower low here. Okay, lower low. So for us to confirm that we are now going to be in a proper downtrend, the market is going to continue giving us a push to the downside. We have to wait for the market to give us a clear breakout at this point. Once it gives us a clear breakout, then we'll confirm why. Because we understand that this was liquidity. The market needed to check out this liquidity before it can continue to the upside. So since we have our higher, we have we have our higher high here, and we have our lower low here. What are we going to do since we have this? Whatever that you are going to see inside here, based on the H2 time frame, this one is going to be considered as your internal structure. Everything here is your internal structure. Everything inside here, this is your internal structure. This is your internal structure. But remember that we said we needed to take out this liquidity here. We needed to take out the liquidity here. This liquidity was supposed to be taken, and this liquidity also was supposed to be taken, which means we know that the market is still in a bullish. Why? Because we understand that the market was only taking out liquidity. So even when you look at the market structure here, it gave us a pullback here to take out liquidity and continued in an uptrend. The market gave us a pullback here to take out liquidity and continued moving up. The market here, what did it do? It gave us a pullback here to take out liquidity. After taking out liquidity, what did the market do? Continued moved up. After moving up, the market gave us a pullback to take out liquidity. Again, that's just how the market moves. That's how the market moves. If it's in an uptrend, it will be giving you pullback to take out liquidity and continue in the direction. If it is in a downtrend, it will be giving you the pullback to take out liquidity so that it continues in the original direction. So you have to make sure that you have some time to go through this, whichever charts that you're going to open, whichever pair that you're going to open. I need you to be observing how the market gives you a pullback to the 50%. I need you to observe that. So the last thing that I would like to talk about is the close, the breakout, how the market gives you a breakout. So the market always has to give you a breakout of the candlestick. This is what we call the breakout. This is what we call the breakout. The market always needs to close above above this candlestick is the one which gave us this candlestick is the one which gave us a break of structure. This candlestick, it gave us the break of structure. This is the structure which was broken by this candlestick. Okay, by this candlestick. So this candlestick tried, but it failed. If you can see this candlestick, it tried, but failed to give us a proper break of structure. It failed to give us a proper break of structure. So this candlestick, it failed to give us a proper break of structure. This candlestick failed. These candlesticks, they did not even touch. Okay, so the moment we had this break of structure, the moment the market closed above, see how the price now had to move. So every time you're having a break of structure, the market has to close above the week of the highest point of the higher high. It should not just be a week unless you are maybe in the lower time frame, you are looking at something else. But it has to be something like this, where the candlestick completely closes above this higher high. That's how it is supposed to be. Just look at this. This is how it is supposed to be always. It is supposed to be like that. That's how it is supposed to be. So every time you open the charts, you always have to remember that when it comes to breakout, you always have to wait for the market to give you a break by the candlestick, not by the wick. It has to be the candlestick, the body of the candlestick, not by the wick. It's not the wick, it is the body. This body has to close above. Once it closes above, we know that there is a breakout. And look at this. The moment it gave you a breakout, it gave you some consolidation on top. These are some of the things that you also need to start observing when the market has reached points of interest like these ones. Okay, so it's either the market will give you a certain consolidation, though this one is not that much, but mainly the market would give you a little bit of consolidation either before the market gives you a break of structure or just after the market gives you a break of structure. You always find the market gives you some consolidation. Why is it giving you some consolidation? Why is the market giving you some consolidation like this one? It is giving you this consolidation to make some liquidity, just for the sake of liquidity. Once the market has liquidity, it can then move to the direction it is supposed to move. So this is what happened even here. The moment the market gave us a break of structure, we had this thing here on top. So this is what the market does. This is what the market does. So watch this video at least 2 to 3 times and get a clear understanding of the market structure. If there is any question that you have, you can just leave the comments so that I can check on it. Thank you very much for watching the video. Have a blessed time and a blessed day.